Zoom just reported earnings and the stock was instantly down 8%. So I went and did some digging and figured out exactly what is going on here. They were expecting earnings per share of 93 cents would have been a 33% year over year decline, came in at $1.05, so they beat on that side. They also came in at revenue. Now their revenue, they were expecting $1.1 billion. Technically, it was a miss. They just came barely shy of that 1.1 million, but it was up 8.8% year over year. Now, something that's very interesting about this, I was expecting the numbers to be a little bit worse. Why? The working from home is kind of loosening up. People are doing less on Zoom. Not only that, there's more competition out there. Apple's coming out with their own competition. You have Google Teams. You have, Microsoft Teams. You have Google Rooms or whatever it's called. So looking forward, this company is expecting to do in the next quarter $1.1 billion in revenue, so they're going to stay consistent with that. They're looking for total revenue of $4.38 to $4.39 billion, which is versus the expected $4.35 billion that they're expecting on Wall Street. So looking into this company, let's scroll down here a little bit and see what I took away from this. Income from operations and operating margin. GAAP income from operations in the second quarter was $121.7 million compared to the same time last year of $295 basically. That to me is something big that you need to pay attention to. Again, when I'm looking at a company like Zoom, I'm looking and saying, okay, this company got a massive, massive spike from the pandemic. There's no doubt about that. Now, is that the new norm? No, probably not. But that's still a fantastic company. Where are they going to settle down? They make a great product. Where are they going to settle down? And where is that company going to go from there? What is going to be the baseline that is going to start that growth again? And as an investor, I look at that and say, I'm going to need to tame my revenue, tame my profits, and just make sure that I'm at some sort of baseline before I start going crazy and investing in this thing. Approximately 204,000 100 enterprise customers. That's up 18% from the same time a year ago. So that means that you have big customers that are using their platform for their businesses, and that has increased 18% over the same time last year, which is a really great thing for this company. Again, I'm pretty surprised from that. Those are the couple of big takeaways that I took from this. And now the stock is only down 4% versus initially it was 7 to 8%. So looking at this company from the 8 pillars standpoint, before we get into the actual numbers, the shares outstanding, this has always been a concern of mine. They diluted greatly during the pandemic, and they continue to do that in order to grow and raise money in that regard instead of taking out debt, because their debt situation is not terrible. The PE ratio, this was at one point just absolutely astronomical, and now it's back at 70 because the price has come down. Let's see, let's go to the chart right here and look at the max chart. So this thing was at a high of almost $600 a share in October of 2020. This is a $568, and now today we're sitting at $93. So let's go back. Let's go and take a look at this income statement here, because for me, I need to see growth, and growth is exactly what we see. In 2018, $60 million in revenue, jumped to $392, jumped to $828, a massive jump right after during COVID, and another big jump to $4.22 billion. Let's scroll down and look at their net income. Now, here's the good news about this company, because you see a lot of these high flyers out there that do not make money. Their stock price goes wild, they drive revenue, but they cannot make money. Something with Zoom, they are making money. They did a net income of $1.26 billion, and just a couple of years ago, they weren't making anything. So the question becomes, this seemed normal. Negative $1 million, $11 million, $50 million. Now, this jump right here, where is that sweet spot in the middle? They got lucky, for lack of a better word. They got lucky with the pandemic, and that's what spiked everything. Where is the baseline going to become, just like I said earlier in the video? Now, shares that we are looking at. Oh, okay. So it's not as bad as I thought. Yes, it is. So they did 237 million shares outstanding, dropped it to 109. That seems odd. There seems like something's going on there. Then it just started to rise, and now they're almost nearly at 300 million shares outstanding. So at what point does this company begin to buy back shares and help their shareholders out? Let's look at their cash situation. They don't have 5 years of data, so we don't have that on our side, but let's look at the free cash flow. Free cash flow of $1.5 billion, down from last year, greatly up from the 2020. Let's see, what else do we have? Acquisitions and dispositions. So I was looking to see if they did any type of acquisition. That's when you get these younger companies, they tend to try to grow from the acquisition standpoint, but I like to see that this company is not doing that. So let's check the balance sheet. I would like to look at their debt situation. Total current assets of $6.5 billion. Total current liabilities of $1.8 billion. Wow. Total liabilities of $2 billion. Total long-term liabilities of $199 million. This company is in a pretty good position at that point. Now let's go back one more thing here. And I said I wanted to look at their, let's see here. Okay, so this company does have a lot of cash on hand. Let's go to put this in Stock Analyzer. So for those of you that don't know, my name is Mo. Paul and I are value investors. We look at companies from a financial standpoint, from the balance sheet, income statement, cash flow statement, just to get a general sense of, do we even want to dig further into this company? We are not looking at a stock price saying this price went from $100 to $600, therefore we have to buy it. We're looking and saying it went to $600, but is it justified at $50? Is it justified at $70? And so on and so forth. So if this makes sense to you, looking at these numbers, stick with me. I'm going to go through Stock Analyzer tool right now. Revenue growth for this company. So 10 years they don't have. Over 5 years, they've done 128% revenue growth. Last year, they did basically 29% revenue growth. I know that this is not sustainable. You know that this is not sustainable, especially with the competition in the space and people going back to work. So what kind of revenue numbers do we put in here? Let's put in a different range from over a 10-year period. Let's say 6, 10, and 14. Profit margin. Let's see, software business. Once they get the product out there, there's not a lot. Let's go with, let's put a range in 15. Actually, you know what? Let's put in a range of 12, 17, and 22. Free cash flow, I'm going to do the same thing. These should come close in the end. PE. Now, this is something that people are going to probably argue with me about. I'm going to give a 16, 18, and 20 PE. I understand that some people might want to see a higher PE on the high side, but to me, there is competition out there. They're not the only game in town. This is not a moat. They're not the best product out there, I don't think. I think there are better products out there as far as Zoom or business conferencing, but I did just say Zoom. They are kind of becoming the word. When you say, do you want to have a teleconference? You say, do you want to have a Zoom call, even if you're not using Zoom? So where does my numbers land? Current price is sitting at $92 right now. That's based on the earnings, which are down 6% afterwards. So I'm looking somewhere in the $22 to $85 range. And honestly, I would probably start looking at this thing in the low 40s, maybe in the 30s range. And that might sound crazy to some of you, but to me, there's a lot of things that this company needs to continue to do. And I need to get to a baseline. I've said it a million times in this video. I need to get to a baseline before I make that decision. Are they going to be able to sustain this through the future? And that's why I used these numbers here, low end, 6% revenue growth. Do I actually think they're going to do 6% revenue growth for the next decade? No, I think that's probably low. But if I stress the situation, what price do I have to pay today to get that 15% return over a 10-year period? The last thing I'm going to hit right here is trading. This is a good stock to trade because it has the volatility. It has the consistent volume in it. So if I'm you, the thing that I need to pay attention to is where it's at in relation to these major moving averages. You are below all four of them. And with this move that we're getting right now, it was down about 6%. That is going to push this thing further away from the 100, 25, and 50-day moving average. So if I'm you, I'm seeing what it does tomorrow, kind of sits right here. And if it continues its downfall, just jump on it because you are getting the stochastic that's worthy of it. Not only that, you are going to get a very nice, clean downtrend that is just going to keep going down, 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 somewhere to this probably 80 range, 75 range, something that is going to benefit you on the short side. Shorting is a great way to make money in a down market. Do not be scared of it. Come and learn the process from me. If you guys do want to learn more about my investing process, click this video right here. Catch you on the flippity flop.